And again, we appreciate you taking the time today and joining us for our second quarterly webinar this year. We have a lot to discuss and hope everyone has been enjoying their summer and as well staying healthy during this unique time in our history. So why don't we kick it off? So I think the major theme over these last 3 months or so, especially since about March, has been don't fight the Fed. And we're seeing right now, especially, how that has played out. It's been really, really important to, both factor in what's going on in our economy, but factor in what the Fed has been doing. And with Jay Powell at the control, he stepped up pretty considerably to help the economy and especially those who, small businesses and those who lost work. And we have some slides later in this presentation to see just how much of an impact that had. As for the second quarter of the year, the biggest bounce back was actually in small cap stocks. They had the best run over the last 3 months or so. Still underperforming for the year, but they had considerable bounce back during the second quarter. Large cap equities continue to be the driver amongst all equity classes. And we're seeing that especially in the largest companies, whether it's Amazon, Microsoft, Apple's of the world, these large technology companies that are solid, strong growth companies, but they've also were best aligned to deal with a pandemic like the one that we saw. And when you go to the bottom of this chart, bonds have been tricky with the low interest rate environment, obviously. But given the drop in interest rates, bonds have done very well so far this year. So we'll look at what our tactical positions have been so far. So, from a tactical standpoint, we really haven't had any major changes in the second quarter, aside from putting and redeploying some of the cash that we raised early on in the pandemic. We started raising cash just about the end of February. And, we started putting that back to work over this last quarter. We continue to be overweight U.S. equities, continue to be overweight technology, which both of those have helped us through this time. Low volatility stocks we put some exposure to, and we continue to hold dividend stocks in this low interest rate environment. Some of those dividend payers are solid companies, have withstood some of the volatility, and are yielding some dividends there. And we continue to hold a little cash on the sideline with all the uncertainty that we'll be talking about today. We do, and we'll talk about as we move forward our plan to get that redeployed. Our underweight international equities, high volatility, and high yield debt has been what we're currently underweight. So let's look at what we've seen so far in the coronavirus and the impact it's had. I mean, we don't want to focus just on the coronavirus, but obviously right now this has been a major sticking point with both the economy and the stock market overall. I think right now, with all the negative headlines and the negative news, it's good to kind of focus on a little bit of what's been good there. When it comes to fatality rates, this has been pretty instrumental, especially as it relates to our stock market, but also just from a healthcare perspective. When you look at our country compared to some other developed countries around the world, our fatality rate it's been relatively low. It's still been scary, but it's been relatively low, and it's still on the decline, and that's a good thing. And in terms of why this has been important, we look at the number of patients and how their death rate has been doing. And, it shows that we're getting a better handle for this disease and this virus. And like I said before, if you were to overlay the stock market with some of these fatality rates, this has actually sort of been more of an indicator of how the stock market is doing. And when you see those rates continue to go down, even though we've seen an increase in cases, seeing the death rates come down has been a real positive thus far, and that's been a good thing as it relates to both, hopefully us getting back to a normal, but also to the stock market. And when you look at New York in particular, I mean, we saw it so bad early on in this, and for the majority of us who may live locally in the capital region and throughout New York, again, this has been a positive, and hopefully we stay on this trajectory moving forward, because death rates and fatality rates are really, really important, but even hospitalization and patient rates are going to be really, really key for us to reopen our economy again. Let's get into how the Fed has impacted. And when I said don't fight the Fed, this is why it's been so important as it relates to the stock market. And not everyone may agree with how the Fed has handled it. And obviously there's going to be some long-term discussions to be had with how this stimulus and the amount of debt that has been burdened on the U.S. Is going to, impact, whether it's in 5, 10, 20 years, whatever it may be. But for the short term, it's been a real positive for the economy and our markets. Again, whether you're talking about the financial crisis of 07 and 08 and 09, or, even the Great Depression in terms of the job losses we saw, we have not seen the Fed intervene like we did back in March and in April with their stimulus. And it had a huge impact. You see, so the stock market bottomed out on March 23rd. If you look at this chart right here, you see March 27th was the CARES Act was enacted. Markets kind of stayed relatively flat for the next week or two. Once those stimulus payments started, you see how spending really ramped up here, whether high income, middle income, low income consumers. And that spending and that stimulus really coincided with when the stock market bottomed out. So when you go back to that time period, in terms of new infections and fatality rates, the news was really bad. But when you kind of look at what was going on in the economy and spending, there was improvements, and you can see why there wasn't a huge surprise in terms of having a little bit of a bounce back in the overall markets. We look at the next slide. Again, this Fed stimulus is critical. And when you look at this chart, it just kind of shows what the U.S. total disposable personal income is through this year and forecasted for next. And if things continue on the trajectory as they seem to be going with what the Fed is doing, disposable income for the year will actually be somewhat positive. And that's pretty unbelievable given everything that we've been through, nearly 40 million jobs lost, and having the overall U.S. economy stabilize from this Fed stimulus is truly a factor here. And so the Fed has played a huge role in everything that's been going on and the support that we've seen. We've talked about different recoveries, whether it's going to be V, U-shape, W, pretty much any letter of the alphabet. And thus far, we've seen retail having a really sharp V recovery thus far. Again, that goes a lot in line with how much stimulus we saw coming into both small businesses and to individuals. That's had a major impact of the retail recovery. Now, it hasn't been an equal recovery. I think some companies, the Amazons, Walmarts, companies that were ahead of the game, ahead of the curve, really tech-driven, have been doing much better. On the flip side, you're going to see probably some smaller businesses being impacted this more negatively, unfortunately. But on a grand, high-level scale, we've seen a pretty solid recovery already here in retail. This is a really important element of our recovery, because whether you see it in the U.S. or globally, getting more cars on the road and more gasoline consumption, that's a good indication of an economy getting back to normal. And overseas, we're seeing it more and more with countries that are faring a little bit better with their caseloads versus the U.S. But even in the U.S., we're seeing a pretty good recovery thus far. It's not back to pre-COVID levels, but we're definitely seeing a nice recovery. And again, that just shows that there's going to be more demand and more activity on the road. And so when we kind of take a step back and just look at let's focus on the good that we're seeing right now and some of the data points that we're focusing on. As we've said in the past, the stock market is not the economy. This is always going to be forward-looking. When times are really, really tough and they seem really bad, the stock market could be looking ahead. We're seeing a little bit of that over this past quarter with some of the recovery that we've seen. The Fed has provided ample liquidity and support. And again, that's with businesses, that's with individuals, unemployment benefits, some other factors of stimulus that have been pumped into the economy. This has kept spending levels at, or in some cases even above maybe what they were at pre-COVID. Our death rates are falling nationwide. That's a good positive factor. The stock market, as I said earlier, is mirroring more of that trajectory rather than the increase of cases that we're seeing nationwide. And we're seeing the spending has recovered and continues to improve. And we'll see as we head into the fall and winter whether that stays on the same track, but it is a positive sign thus far. And with as much good as there's been, we have to look at some of the areas of concern as well. There's still a lot of uncertainty and a lot of concern. So let's look at what we're considering as we're making investment decisions here. So we started to see a recovery. These are job posts, going back to March. We saw a pretty sharp decline early on. Then through April and May, started to flatten out and even start to recover through May and June in terms of job posts. Heading through June, again, we're seeing a slight dip right now. That could be a little bit of a sign that the economy is not fully ready to get started. And we'll look at some slides later in this section as to why that may be the case. Again, retail bankruptcies, we're seeing even a higher level than we saw in 07 and 08. Again, even though retail as a whole has recovered, it has not been an equal recovery. You're seeing the larger, more technology-driven companies do well and even outperform, but you're going to see some of these, maybe more retail-driven, in-person retail-driven companies or smaller businesses not fare as well. They're not up to speed with the technology advances that we've seen in consumer behavior. So the consumers are spending, but their behaviors have changed, and that is impacting what companies are thriving and what aren't doing as well. And there is a big divide there. This is going to be key as we move forward, this rent delinquency rate. So, in many states, many cities, local government has added some protections to, not paying rent. And I think some of those delays are going to be enacted moving forward as well. I've seen, whether New York or Boston, and I'm sure it's going to be the case around the country. But, what we have to factor in is with all these delinquencies, especially at a commercial level, who's going to be left holding that bag at the end of the day? It's going to be these major commercial real estate landlords. Is it going to be the banks? At some point, someone's not going to get paid, and they may not see that money. That's going to have an impact, and I don't think we're seeing it quite yet, but that's something to be on the watch for as time goes on. We're seeing a huge divergence in unemployment, and if you look at the top 20% of income earners, they've fared the best. They've lost less than 10% of their overall jobs. They're doing very well. Those lowest income earners, this is where the job losses have been the steepest. You've seen almost a 40% drop in jobs. How many of these, a lot of these have been said to be temporary, but as time goes on, how many are going to be more permanent? And on the flip side, we've seen spending stay relatively flat or even, a little bit up. But if these unemployment benefits, which are set to expire at the end of July. Now there's a new bill on the table, but not sure if it's going to get through the Senate just yet. But if those unemployment benefits, the extra that unemployed benefit earners were getting each week, if that goes away, how does that affect overall spending in the overall economy? It's going to have an effect, and we're seeing some recovery in those jobs, but still about 30% of those jobs haven't come back, and that's going to be something to, again, watch how many of these jobs maybe disappear for good. It's certainly a concern. And as we talk about getting the economy back up and running, a chart like this, there's very, very few states where cases are decreasing or steady. Now, it's great that the deaths are down, and that is a good thing, but we're not going to get back to normal until we can slow down these cases. And for over 80% of the country, cases are on the rise right now, unfortunately. That leads us into kind of this reopening slowdown. The blue is the amount of states that were easing restrictions. I mean, back in June, we almost had 100% of states easing their restrictions. Now we're at the point where about 80% of the population, their economies are either on hold or they're increasing restrictions. Again, we've seen cases rise, deaths are down, good, but if these restrictions continue, that's going to be a headwind on our economy. So to recap kind of our biggest concerns that we're looking at right now, we would look at slowdown in our labor market. Right now the labor market's showing considerable weakness. We've had many temporary layoffs, but some are turning into permanent. And what happens if some of these larger companies start to laying off, maybe some of these higher paid workers, and those unemployment benefits don't fully fill their loss of salaries and earnings? That's something to be on the lookout for. Overall spending has improved, but it's been disproportionate. We're seeing economic figures look good on the whole, but there's many losers, especially those smaller businesses throughout our country. Cases are on the rise nationally. This is going to be a drag, and hate to say it, but the fear of a second wave heading into the fall or winter is a concern, and we have to be on the lookout for that if we don't get these cases under control. And as we said about the rent delinquencies, who's left holding the bag at the end of the day? Some of these big commercial real estate holders. Could it be the banks? Certainly, at some point, I don't think the Fed will step up for everybody. So that's something to just be on the lookout for. So with that, I'm going to turn it over to David Rath to give a little bit of the portfolio perspective with everything going on.
Hi, thank you, Ryan. And just a quick bit of housekeeping. There were some people, I think, that may have been unable to hear Ryan during his presentation. So the webinar will be recorded and distributed on our website. We'll send out a notice when that's ready. Should be within the next 24 hours. So hopefully you can hear me, and if you want to hear Ryan's piece in addition to the slides, you should be able to hear them in short order when we distribute the recording. So I'd like to start off by going through one of the major themes that's present in the market, and that has been the performance of technology companies. And the QQQ, which anybody that's invested with us is acutely aware, has been a great performer. As you can see, as of July 15th, it's actually up 22% for this year, which is absolutely incredible given everything that's happened up to this point. So the performance of the Qs has really buoyed the domestic markets in addition to our portfolio that we manage, as you can see, related to the S&P, which was pretty much flat for the year as of that point, is outpacing international equities, which are down for the year. So one concern, I guess, that people have when looking at the performance of technology companies is it reminds them a lot of what happened in 1999 and 2000 and the tech bubble that we saw during that time frame. So I'd like to show you a chart of the growth of the NASDAQ 100 from a 5-year starting point up till the absolute peak in 1999. As you can see, over a 900% return over that 5-year period, which is absolutely incredible and somewhat unbelievable. And as we saw what happened next to the NASDAQ. I think people are worried about that happening to the NASDAQ today as well. But if you go to if we look at what that picture looks like today, I ran the performance of the NASDAQ 100 back 5 years, and you can see over the last 5 years, it's returned just over 130%. And so while there might be the argument that valuations are stretched, I think that comparing it to 1999 is an easy comparison to make because it's still fresh in our minds, but it doesn't really compare to the absolute hysteria that we saw during that time frame. However, one thing to bring up is the fact that those companies, the Amazons, Microsofts, Alphabets of the world, are becoming a larger and larger part of not only the NASDAQ 100, but they're also becoming a larger part of the S&P 500. And this is something that we addressed during our State of the Economy presentation. And the reason why we're starting to add more to our equal weight position in the domestic markets, as I mentioned during the State of the Economy presentation, the larger that these companies grow, the harder it is for them to continue growing at that rate. It's not to say that it's going to turn on a dime and turn around, but it does become harder to grow $1 trillion or $1.5 trillion company beyond where it would be to grow the 500th largest company in the S&P. So as a result of this, we are adding to our equal weighted positions in the large cap space much more than we are to our market cap weighted positions. Now, I think everybody's topic du jour is what's going to happen with the upcoming election. And we stated our case during our State of the Economy presentation, and I'd like to reiterate that here. If you only invested based on when your political party of preference was sitting in the White House or controlling Congress or whatever the case may be, you would have lost out on a lot of growth. So this isn't necessarily a call one way or the other, Democrat or Republican. Essentially, if you look at that right-hand bar, if you just stayed invested throughout the time period, regardless of who is sitting in the White House, you made out well. And I understand that some people are saying that this is a different time period and things are different this time. However, I would contend that much more of a president or an administration's success in the economy and the market has to do with their timing of when they come into power, when they come into that presidency. A good example of this is looking back at 2000. Was it George Bush's fault that he inherited an economy and a market that had just gone through some of the biggest run that we've seen in the 90s? So there wasn't really much that he can do as far as the economic cycle and the market cycle. These things go through cycles over time, and really the person sitting in power doesn't have a ton of effect on the market, as you can see in this chart here. Now, another concern for people is the inflation. And as Ryan mentioned, there has been extraordinary measures taken to stimulate the economy, to put money in people's pockets, to keep interest rates low. And people are worried about inflation in the future. However, as you can see, in certain areas of the economy, inflation has been much more than the quote unquote average since 1997, which is roughly 25 years ago. So things that we're very aware of are the cost of tuition, the cost of medical care. Those things are rising at a much faster clip than other areas. And we're actually seeing some deflationary pressures in things like electronics and any sort of technology. And so as a whole, inflation is somewhat steady. And moving forward, we're going to talk about what that means for the overall inflation level based on the effects of some of those policies that were enacted. So this chart right here, I just want to take a second to explain it. The blue line represents the M2 money supply, which is essentially anything that's circulating through the economy via paper bills or checking accounts, in addition to anything that can be readily converted to money, like a savings account or a money market fund. And so, as you can see, the year-over-year growth of that M2 money supply went up 25% based on the stimulus that was provided to combat the effects of coronavirus. whereas the orange line represents the velocity of money. And an easy way to think of this is how often does a dollar change hands between a consumer, a business, and back to consumer, and so on and so forth. So as you can see, that's been declining over the last 10 or so years, while we just injected a lot of the M2 money supply. So what happens when that demand for products and services catches up with the amount of money that's being held in that M2 money supply? It's not something that we're going to make an absolute prediction on, but it is something that we are keeping our eyes on. And one of the unintended consequences or unexpected consequences that we saw is, as you can see at this chart, the personal savings rate for people went absolutely through the roof, because not only was there a replacement and even an addition to people's income that were laid off, but people weren't going anywhere. They weren't spending money. They weren't doing anything. So the stimulus that was received by all parties, in addition to the extra unemployment income, really augmented the savings rate that we're seeing in the country, which ties back to that last slide. It's a lot of money that's waiting on the sidelines, waiting to go. We've seen some of that in the rise of people being interested in investments, which is overall a good thing, I think, but it's also something to be aware of when it comes to that velocity of money that we spoke about, and as that money starts to recirculate through the economy. Another aspect of this recovery that's somewhat atypical from a normal recession is the performance of the housing market, and a lot of that has to do with where mortgage rates are right now. This chart shows 3.07 for the 30-year. We just broke below that 3% mark, which is the lowest ever for a 30-year mortgage. You can see a lot of the new single-family homes being sold, as well as the ownership rate of houses or home ownership ticking up. I think a major theme at play here is not only the lower interest rates, but also people realizing that maybe they don't want to live in a city environment anymore. They want to move out to the country. So there has been an upward thrust in the housing market. And this is one of the major themes that we're focusing on as we're looking about how to position our portfolio for the future. And somewhat related to that has been the uneven impact on retail. As you can see, there's a big kink in the curve right here for the revenue of different retailers. So your department stores like Macy's, Nordstrom, Ross stores, they all experienced significant downward pressure when the impact of the coronavirus hit. However, retailers like Lowe's, Home Depot, and Walmart all saw an increase in their revenues. So this is one of those themes that you look for in the economy to try to position yourself to benefit from it. And those department stores were already coming under some pressure because people were shopping more online, and retail was going the way of the dinosaur almost. And this really just gave it a kick into overdrive. So as you can see, the impact of the coronavirus had different effects on different types of retail industries. So just to summarize, the market and our portfolios have been buoyed by our holdings in technology companies. Despite the market being a bit top heavy at the moment, we are taking measures to adjust to that. Again, to reiterate, for the outlook for the election, doesn't matter which candidate you're rooting for, there shouldn't be a causation of what's going to happen in the economy and the market. Now, there might be a cause for concern with future inflation. Again, that's something that we're keeping an eye on, and we track that every day. And then the housing market being atypically strong during a recession is something that might work its way into an investing theme in the next coming months. And so I'd like to remind everybody that we do have open lines of communication when it comes to the question and answers. So if you do have a question for any of us, feel free to reach out. You can always reach us via phone or email. We'd be more than happy to answer any questions that may have come up from this webinar. And to reiterate what I said when I jumped on, if you had any trouble hearing or with any issues with the audio, we will be providing a recording of this, and that should be available within the next 24 hours. So I appreciate everybody joining, and look forward to hearing from anybody that has any questions.